heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, Tesla recalls 2 million cars to fix autopilot safety flaws. We'll break down what it means for drivers and indeed the EV maker as it faces its biggest recall ever.
And Apple is set to be hit by an EU antitrust order in its fight with Spotify over rules that govern the iPhone maker's music streaming rivals. We'll break down the potential ban.
Plus, for the first time ever, Netflix is revealing viewer data on every show in an effort to boost transparency. That's in the wake of the Hollywood strikes. We'll discuss that and so much more throughout this hour.
The other top story is Tesla, and actually Tesla's declines have really accelerated. This is a recall in name only of 2 million vehicles. Tesla plans to fix the issues around autopilot with over-the-air software updates. Those started on the 12th, which was yesterday. Let's get the full picture and bring in Bloomberg's Keith Lang out of Washington, D.C. What do we know about this Tesla autopilot recall?
Well, this recall is years in the making, literally. NHTSA, which is the top auto safety regulator here in Washington, first began looking at autopilot in 2016. And the pace of the investigations definitely picked up under the Biden administration. The agency launched the current probe into autopilot in 2021. And then they also launched a probe into Tesla's full self-drive beta system in 2022. And NHTSA said that those probes were, this recall is a product of those probes, that Tesla has agreed to recall almost all of their cars across all models and push out this update, which they say will address some of the flaws with making sure drivers are fully engaged and aware that the cars are not capable of driving themselves. The autopilot system is also subject to several other investigations of other agencies. Tesla's faced criticism of their marketing of the systems, with people pointing out that there are no cars currently on the road that are capable of full self-driving.
I mean, what is it? The agency has opened more than 50 special crash investigations involving Tesla cars that are suspected to be linked with autopilot. Ultimately, it feels as though this is just an awareness, an education process to the driver. Why isn't this something that other regions are looking into, not just the United States?
I think a lot of this is centered on Tesla's marketing, as I mentioned, of the systems in the vehicles. I mean, they have the system that they're calling full self-drive, and even they acknowledge that the cars are not capable of driving themselves. So I think that's why there's a bigger focus on this in the United States right now.
A little bit more of a marketing message, perhaps, and indeed just making people, well, basically have their hands on the steering wheel that little bit more. Keith Lang, really great to have you on the show. Thank you so much for joining us. Meanwhile, let's stick on Tesla and at least its leader, Elon Musk, because X, we understand, of course, his social media platform, is on track to bring in roughly $2.5 billion in advertising revenue in 2023. It's a significant slump from prior years. It's all according to people familiar with the matter. We know we want to talk to one, Kurt Wagner now, who put out this story. And just give us the context here. How much of a fall-off is it?
Yeah, I mean, it's well over 40% from the last full year that the company reported, which is 2021. Obviously, last year we didn't get full numbers because the deal had closed in the middle of the year. But, you know, this is a huge deal. Twitter, or now X, has historically made about 90% of its revenue from advertising, right? And so when you see this big decline in their core main business, it's obviously not a great sign. And that's why you see Elon out. You know, a couple weeks ago, he was saying, hey, this advertising issue could lead to real trouble for the company. He's talked about bankruptcy before, right? And that's because this core part of their business is really struggling.
Okay, you and I have been crunching numbers and talking to sources about what's happening right now, because a lot changed from the second to the third quarter to fourth quarter. My understanding is it's 75% ads, and then the 25% that remains isn't just subscriptions for Premium or Premium Plus.
Right.
It's data licensing.
Yeah, actually more data licensing than subscriptions. What our understanding is that the subscription part of that business is very small. I think the external estimates are about 120 million a year. We'd heard that there's just over like 1 million paying subscribers right now. The data licensing historically has been, a much bigger business, $500+ million, and that's for, people who are paying for access to what we call the fire hose of tweets, right? All of the tweets that are coming through, public tweets. And so that business, I believe, has stayed maybe a little bit stronger because it's not as impacted by, Elon Musk coming out and saying the things that he says that advertisers are bothered by.
Right, and real quick, an ex-executive did respond to our story. You can read his full statement in the story, which says we gave an incomplete picture of what their business currently looked like. Bloomberg Technology's Kurt Wagner. Thank you. Kara, what you got?
Well, let's dive into time for Talking Tech, Ed, because we're going to stick on the world of Elon Musk. But SpaceX this time will sell insider shares $97 a piece in a tender offer, a price increase that boosts the value of the space and satellite company closer to $180 billion, according to sources. Meanwhile, Tesla posted a video showing improvements it's made in its humanoid robot prototype. Dubbed the Optimus Bot, the human mimicking machine is part of Tesla's venture into developing AI, and it utilizes a trained neural network to perform basic tasks. And maybe have a bit of a dance as well, as you can see in this current video. Meanwhile, over in New York, the law could require social media platforms to provide data at no charge to third-party apps that allow users to block hate speech, which has been surging online. Now, this comes after X and Reddit began charging third-party apps earlier this year. Ed, what have you got?
Coming up on the show, Apple is in the crosshairs of EU antitrust regulators about its App Store rules for music rivals. We're going to bring you all those details on that Bloomberg exclusive. Plus, Netflix ready to tell the world how many people watch its shows. We will have all of that data next. Very quickly, shares of Etsy have paired a decline of as much as 8.5%, currently down 5% on track for their biggest drop since September, cutting 11% of the marketing workforce and also giving us an update on their outlook for the fourth quarter. Gross merchandise volume is going to drop in the low single digits. Top line growth 2 to 3%, but this is a real slowdown and clearly things not going well for Etsy. The stock down 4%. This is Bloomberg Technology. Apple is set to be hit by a ban on its App Store rules that govern music streaming rivals and a potential hefty fine, that according to Bloomberg sources. EU regulators are putting the finishing touches to a decision that would prohibit Apple's practice of blocking music services from pushing their users away from the App Store on iOS to alternative subscription options. The decision is slated to come early next year. Let's bring in Bloomberg's Aggie Cantrell out of Germany for more on this. This is anti-steering provisions that the EU is trying to address, and the potential penalty for Apple is large, a fine. What do we know about it?
Yes, so essentially the fine itself could be up to 10% of annual sales for Apple. And that's a real concern for the company, of course. And in the past, we've seen that the EU has really been at the forefront of incredibly tough regulations on big tech. This is especially coming from the EU's antitrust czar, Margrethe Vestager. And this is also coming at a time when the EU is about to launch its Digital Markets Act provision next year in March. And that's going to be a critical focus for big tech, because essentially that's designating companies like Apple as gatekeepers for our online ecosystem. And that really means that those companies need to conduct their business practices in a way that is not anti-competitive for the smaller players in the market. And that is what is being discussed here. This suit was originally brought forward by Spotify almost 4 years ago. And what we're essentially seeing now is that Apple may have to change its practices. It may have to allow for platforms to facilitate the App Store to facilitate people being able to go to other subscription platforms like Spotify. And the reason for this, for Apple changing their practices, this isn't the first time that they've actually thought about doing this off the back of EU legislation. We also saw this, for instance, when the Apple App Store, that Apple announced earlier this year that we would most likely have to consider allowing third-party app stores to access to iPhones as of 2024 off the back of the Digital Markets Act.
Other than competition, the EU is being pretty busy, Aggie. It's also being busy when it comes to labour protection. Just tell us what they're considering or proposing when it comes to workers of, well, Deliveroo, for example, or Uber.
Yes, so essentially the Platform Workers Directive is about trying to standardize the labor rights for gig economy workers. Essentially, there are a lot of people who work for these platforms that are currently deemed self-employed, and the EU believes that around 5 million, so about 19% of the self-employed platform workers in the EU are misclassified and should actually be considered employees. And they have built out a system of criteria. These criteria include, does the platform you work for have control over your hours? Do you have an upper limit on how much you can earn on that platform? Is there control over your appearance or your conduct while you're working on that platform? So what most people would consider standard aspects of being employed, and if 2 of those 5 criteria are fulfilled, the proposal is essentially that then those people would be considered employees. But this is still in a preliminary discussion. The deal has been met, but it's still awaiting approvals from the European Parliament.
Business models under fire. Aggie Cantrell, thank you so much for joining us. Meanwhile, let's stick on a part of Europe because Airbnb's Irish unit has agreed to pay the Italian tax authorities 576 million euros, which is $621 million US dollars, to settle allegations that it hadn't paid enough tax from 2017 to 2021. Now, the home sharing company says it doesn't acknowledge, quote, any liability as part of the settlement, according to the regulatory filing. Ed, what's going viral?
Yeah, what has been going viral is Netflix releasing viewer data on every single show and movie on its service. It's the first time that what the streaming giant says will be regular reports. Bloomberg's Flex Gillette joins us now. This is the biggest disclosure from Hollywood or any streaming service anyway. Infinite amounts of data on 18,000 titles. What did we actually learn from it?
Well, we learned a lot. I mean, we've been waiting for this moment for 10 years, wondering what exactly people are watching on Netflix. And I think the biggest takeaway from yesterday is that, more than 50% of the viewing in the first 6 months of the year was driven by Netflix originals. So original movies, original TV series, and that's sort of a validation of all the spending that has been done on original programming by these streaming services over the past several years.
I gotta say, I haven't watched a single minute in any of those. I mean, maybe that speaks more to a parent than it is to Netflix lack of addiction. But ultimately, this has been forced in some way by the strikes. Why was this transparency wanted?
Well, the creative community has been demanding more transparency for years. I mean, there was really no way to know if your show was a hit, was it a failure. You kind of had to take the streamer's word for it. And so Netflix, yesterday acknowledged that part of this was that by keeping this data to themselves, it had built up all this mistrust with their creative partners. And so, this is a way for everybody to know this is where you stand, this is what people are watching. And it's a big flex by Netflix also because it's going to show the world how much more people are watching on Netflix than any of the competitors.
And it's important for the actors in the context of the strikes we just had because this was at the center of talks.
Yeah, I mean, also the compensation model in terms of, rewarding, creators and actors, and writers residuals based on, if your show was really popular. Part of that was you need to know what's popular. Now that data is going to go to the guilds anyways, but it also now allows the rest of the world to check this out. You can bet that every writer, actor, producer, even the competitors are going to be pouring through this data wanting to know, okay, this is what people are actually watching.
Bloomberg's Flex Gillette, thank you so much.
I think investors need to get confident that the Fed is done raising rates. I don't think they need to lower them a bunch for the IPO market to happen, but I think, or to pick up. But I do think they need to get a sense that, rate rising is done, which, who knows. I expect we'll see more tech IPOs in 2024 than we saw in 2023, but that's not very hard to do. You don't need many.
Important as we look ahead to Fed Day, which is today, a little few hours ahead of time. Mitchell Green of Lead Edge Capital with his outlook on what Fed's decisions mean for the IPO market. Joining us now with her perspective, Rachel Gehring, she's EY IPO practice co-head. And is, Rachel, the IPO market, particularly tech IPOs, going to be dictated by macro, or is there some more, LP pressure that's going to come in?
I think it'll actually be a combination of both, but the improving macro backdrop is certainly going to help the situation and making it encouraging sitting here today as I look ahead to 2024.
Rachel, just like me getting organized with my holiday shopping, my understanding is that behind the scenes, there's a lot of work going in to preparing for IPOs in 2024, the groundwork and confidential filings. Does that tally with what you're hearing from clients and from your network?
Absolutely. Not only what we're hearing from clients, but what we're experiencing firsthand. Really encouraged by the amount of preparation companies are putting into their IPO plans, whether that's for 2024 or even beyond into 2025. Clients are really taking this opportunity of the lacking of IPOs happening today, that's being used and the time is being used today to prepare for the future and really to be able to optimize when the market does return, allowing these companies that optionality to take hold of that market opportunity when it's right for them.
There is a market mechanics story happening where companies are filing confidentially and then doing nothing, sitting on it. In your experience, how much flexibility does that actually give a company filing confidentially on the timing and method of going public?
I think it really does provide a lot of optionality, and it's definitely a course we would always recommend for clients. One, it's allowing companies confidentially, as you mentioned, to work through that process with the Securities and Exchange Commission, work through those comments and so forth, without the pressure of needing to go on file publicly eminently. And as the broader macro backdrop continues to play out, and continue to improve, that's when companies can really choose the timing that's right for them, but be ready, have a lot of the review process complete, be ready for that roadshow, and then really complete a very efficient process in that last part of the IPO journey.
And then be ready to be a public-facing company. In many ways, I remember speaking to Fiji Simo over at Instacart after their listing. I was like, well, how is it after your first quarter of being a public company? She's like, I've kind of been doing this for ages because they've been waiting to go public for so long. They'd had all that documentation and rigmarole anyway. To that point, are you likely to see, some of the companies that do eventually go public have a similar sort of business model to an Instacart in terms of showing some sort of evidence of profitability? Do they have to be talking up AI a lot at the moment, or will more types of companies come?
I think we're going to continue seeing companies come to market from a broad range of sectors. I anticipate looking ahead to 2024, it will probably be much of the same. So meaning large companies scaled already with profitability or eminently reaching profitability. So I don't anticipate that changing immediately. But as the current crop of IPOs continue to perform, this very next crop of IPOs perform well, then I see the IPO opportunities broadening to others, kind of that more traditional tech type company, probably in the later part of 2024.
Ultimately, do you think the sort of pressure that a lot of these companies are under to go public for a liquidity event, to give money back to LPs, to employees, has it become in some way unsustainable? Have there been too many VC-backed companies of late?
Well, we definitely are seeing, a rise in VC-backed companies and then long holdings, right? So there's definitely pent-up demand when you think about PE, VC investors. They've been holding these investments for a long period of time, definitely anxiously awaiting a monetization event of some sort. We're seeing the IPO market, slow, the M&A market slow. So definitely a lot of pent-up demand. But at the same time, the PE investors, those VC investors are also recognizing the importance, particularly around valuation. We still have that valuation tension of what buyers want to sell and buy at versus what companies are targeting themselves. So that valuation tension is still there. I think to get deals done going into 2024, having realistic pricing expectations is an absolute must.
Rachel, what about the competing forces? What are the biggest factors that are causing technology companies in particular to hit pause, hit the brakes and hold them on going public?
Really, I think the broader macro backdrop, I think, is one reason why companies are waiting on the sidelines. We'll see what happens today. I think everyone is expecting the Fed to hold tight on interest rates. We've had IPOs in high interest rate environments before, so it doesn't mean that we can't continue. It's the predictability. I think companies want to know that rate hikes have stopped, and then even see some encouragement that they might even start to come down sometime in 2024. So that level of predictability will be definitely helpful for the IPO backdrop. And then broader macro trends. The data is trending in the right direction, so provides hope for 2024, absent any unforeseen shock.
Rachel Gehring of EY, thank you so much.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
I'm Ed Ludlow in San Francisco. Caro, I was going to bring you a magic market moment, but then trading on the NASDAQ 100 in the session conspired against me. This is what the NASDAQ 100 looks like year to date, and we're way off session highs this morning. But for just a moment, we're at a 50% year to date gain on the NASDAQ 100. And the reason I bring that up, so you look at the far left-hand side of the screen, a lot of that recent momentum has come since November 1st, which was the last Fed meeting on the NASDAQ 100. More than 100 names, but largely higher multiple software stocks, the mega caps, some of the EV names as well. And that's why I track that index. It is Fed decision day. The expectation for this meeting, absolutely nothing's going to happen. But think about 2024 and the narrative that's coming. The white numbers that you're looking at are the forecast for cuts at the next meetings across 2024. The red numbers are the one-day changes in expectations for each of those meetings. And whether you think about private markets like venture capital or you think about public markets, historically, when rates are high, investors assign more money to bond funds, less to equity funds. So the world is watching. If you're a VC or you're an equity market trader and you think about technology, then you care. Let's continue the Fed conversation and bring in Joe Chow, co-founder and managing partner at Millennia Capital. And Joe, I guess, is that where your head is at this morning as you wait for the Fed?
Well, thanks, Ed. Good to see you again. Yeah, exactly. So, we're expecting the Fed to pause and to start cutting in 2024. And when the Fed begins cutting in 2024, then market participants like us, private equity and venture capital funds, we can begin to build in these rate paths into our financial models and really begin to do more deals. And all things equal, prices of companies are just future cash flow divided by discount rate, which is basically the Fed funds rate plus a premium. So when the denominator goes down, the price of these stocks should go up, and that's why you're seeing the market reactions in public markets. And I expect that will extrapolate to the private markets in 2024 as well.
Joe, the reason we love you is not only because you're so active in the VC community, but also you used to work within monetary policy over at the Fed. And I'm interested as to how much your view on valuation has shifted, or your pitches have ultimately been based upon the fact that all these valuations we see at very heady heights, it feels like, for AI, are still happening when interest rates are pretty high and they might come down.
Well, a couple of points. One is, the last time I was on your show, I made the point that if AI is this big when in a very tough monetary policy environment, imagine when monetary policy and financial conditions recede, how much bigger the AI phenomenon is going to be. And AI is big because the total addressable market is unthinkably big. But when it comes to fintech and VC investments, right now, I speak with a lot of LPs, whether they're sovereign wealth funds, institutions, pensions, family offices. If you're an LP, if you put yourself in their shoe, and the math is pretty simple. If you can allocate your capital into a fixed income fund and generate, let's say, 5% in treasuries and 10 to 12% in credit, and probably a little bit higher, 15 to 18% in some of the venture private credit, why would you allocate your capital to venture capital and get 20 to 25%? So that's sort of their thinking. So right now, and that's what we've seen in the last 18 months. But what you're seeing is right now, LPs are active in venture secondary funds, private equity secondary funds, because secondaries, you can actually buy some of these shares at 50 to 80% down in private markets. And the second thing is as soon as the IPO market reopens and you're seeing sort of the LPs getting their capital back, then LPs will be able to reshuffle their capital back into VC. So what I'm trying to say here is the last 18 months in venture has been probably one of the toughest periods in recent memory in the last 10 to 15 years since the GFC. If you're a VC fund, you're a founder, and you basically held your ground in the last 18 months, you basically may have passed the test. So right now, what you got to do is you got to just hang tight, keep working, and 2024 should be a much better year for asset class.
I just think of, for example, those that did decide to take it on the chin when it came to valuation. I think of a Stripe, for example, and still some of those shares are available on the secondary market for a lot less than their peak valuation, but not all are below. I think of SpaceX, for example, that I know is in your portfolio, and they're currently looking to be selling inside shares at the moment at huge valuation. What do you make of that?
Yeah, I would say, when I look at a name like Stripe, the fact that its valuation, the new round is down 50% from the last round is actually not a surprise. There's a couple of reasons. One is, you just put in a higher interest rate in the financial model. The 50 billion or so in valuation is actually, fair value, right? Versus the $95 billion that they had to raise that last round. And then the second thing is, in public markets, whether you look at the peer group of SoFi, Marqeta, you look at, Nubank, dLocal, et cetera, Robinhood, the public peers are also down, more than 50%. So it makes sense that the private names are also going to be down 50%, a little bit more. So the valuations are justified based on a DCF model.
Hey, Joe, been writing any checks in the world of AI that you want to tell us about?
Been working a lot on these names. Again, AI is, as we look at, last time I was on your show, I made the point that AI is really software squared. AI is the next generation of technology. As we think about, the evolution of tech from mobile to internet to cloud to AI is just the next generation of technology. And so, right now, I guess what I'm seeing in the private markets, we saw this in 2021, that a lot of the deal flow that we began seeing in 2021 was getting a little bit repetitive. For example, you would see many, many payments businesses for every single purpose. But AI is really going to lead every vertical into the new generation. And so when we think about AI, we've invested in several of these AI companies. We're really investing in the infrastructure layer, betting on the whole industry. And in the next 5 to 10 years, we expect to see existing tech verticals like software and cyber and fintech to marry AI and basically drive the next leg of growth.
Joe, what's going to be keeping you busy in 2024? Whether it's thematically or you're just under pressure to find some exit somewhere from your existing portfolio?
Yeah, we have several companies in the pre-IPO pipeline, and we expect them to file in 24 and 25. And then second to that is when we look at new opportunities, there's two strategies. One is we're looking at a lot of secondary opportunities because some of the early shareholders would like to cash out. They've been in the company for 10 to 15 years. Some of the early VCs also need to seek exits because their funds have to be shut down. Their LPs are demanding their capital to be returned. So this creates a really good opportunity for secondaries focused funds to be able to find some value in private markets. And then secondarily, it's AI. We think AI is the driver of growth. And as we're going to the new business cycle, it looks like the Fed is almost done or is done. And as the Fed begins to cut and equities receive more capital from allocations from LPs, we're seeing sort of, everything kind of rebounding for venture. So we think that starting in 2024, 2025, things in venture should get a lot easier.
Haves and haves not. Joe Zhao, thank you so much. Millennia Capital, great to have you on. Meanwhile, let's just shift gears a little bit and go back to the world that was all the hype back in 2021, not so much now. Crypto. Three Arrows Capital co-founder Su Shou, for the first time, faced questioning in the Singapore court about the crypto fund's collapse, giving liquidators their best chance yet to gather information as they seek to recoup some of the billions of dollars for creditors. Now, the two-day court hearing this week required Shou to respond to lawyers for the liquidator, Teneo. People familiar with the matter said. Ed.
All right, coming up here on Bloomberg Technology, Charlotte Slayman from Public Knowledge joins us in the efforts to rein in the power that Google and Apple wield over their app stores. We will get back to that top story about Apple's antitrust action in the EU as well. This is Bloomberg Technology.
Let's just take another look at the shares of Apple and Spotify, because as we were mentioning earlier, Apple is set to be hit by an EU antitrust order in its fight with rival music streaming platforms such as Spotify. Bloomberg's Mark Gurman joins us now to discuss what seems to be everyone taking aim at these app stores. What's the nuance in this one, Mark?
Yeah, so today we reported the European Union is going after Apple about this interesting rule, right, that actually Apple mitigated a couple of years ago, right? So Apple for a long time did not allow outside developers to advertise lower pricing from outside the App Store. The other thing Apple didn't allow were developers like Spotify to include a button in their app where you can click the button to go to Spotify's website to sign up. They made you sign up via the App Store through in-app purchase, which gives Apple a 30% cut. Now, Apple mitigated this starting in late 2021. They allowed developers to advertise lower pricing via email to customers. They also, starting in early 2022, allowed Spotify and other what they call reader apps, anything having to do with video, cloud storage like Dropbox, some business apps, music, magazine, books, newspaper apps. Reader apps is the name for that category. Allowed them to point out to finish the transactions online. But now the European Union is going after Apple for that old practice, ensuring that that practice doesn't come back into effect, and potentially the company could be fined for having done that. Obviously, Spotify is a European company. It has been pushing against Apple's rules for some time now. And that, combined with other lawsuits, we've seen the Epic Games lawsuit a couple years ago, different settlements Apple has had with the Japanese Fair Trade Commission, with developers in the US. The App Store is starting to crack open a little bit, as is Google Play, the application download store on Android.
Bloomberg's Mark Gurman there with a pretty decent explanation of anti-steering provisions. And on that fine, up to 10% of global revenue, which if you take fiscal 22 or the estimate for 23 is $40 billion potentially in fines. Whether or not it happens, we will see. Let's keep the conversation going on Apple and also talk about Google after its defeat to Fortnite maker Epic Games in court earlier this week. Now, with key legislation in Europe, investigations in the US and the UK, and an expected wave of follow-on suits, the pressure keeps on piling onto the tech giants, which Epic describes as a duopoly. I want to bring in Public Knowledge Competition Policy Director Charlotte Slayman to go over what has been an incredible week in the world of antitrust. Let's start with the anti-steering provisions in Europe and Bloomberg's report on that action against Apple. What do you make of that?
Yeah, so this is a problem that we've seen in the U.S. as well. And we don't have that legislation in place, right? There's legislation in Congress right now, the Open App Markets Act, that would address this rule that Apple usually uses in the U.S. that prevents apps from being able to tell customers, you can get a cheaper price if you come directly to our website. So that continues to be a problem here. Consumers are paying more as a result.
These are big stories, but what is always so surprising is the lack of response in the stock or the share price. I know that's not your domain, but it begs the question, how likely is it that the courts in the United States or the European Commission in Europe will actually follow through in making Apple, as an example, or Google, adjust policy?
Yeah, so I think they've been learning over time. We absolutely have seen antitrust cases in Europe that have been successful until you get to the remedy stage. And the remedy that they choose is not effective. And so competition doesn't really come in. And that's really frustrating from the perspective of a consumer advocate. But I think that's something that the enforcers are learning. Those remedies can be really difficult to craft, but they're learning over time. And so I'm hopeful that they can be more effective going forward.
And how will they become more effective? Because thus far, I mean, Congress has been looking into competition policy more broadly, but to put it bluntly, nothing much of significance has been done. The FTC, meanwhile, has been trying to stop certain deals going through and failing there. I'm interested as to whether you think there will be a shift from actual putting the right laws in place, even if the courts, we're all not going to hold our breath on the Supreme Court, I guess, where Epic Games goes next.
Yeah, so I think we need to be using both of those tools, right? Congress needs to pass the legislation that they've been working on. It's not just the Open App Markets Act, but there's the American Innovation and Choice Online Act. There's the America Act, which focuses on ad technology stack. So Congress needs to work on that legislation so that they can get it over the finish line. At the same time, the agencies are bringing these cases these can both be long processes, unfortunately. To move the law forward by bringing case after case, it can take a long time, and it makes perfect sense that the agency would lose the first few cases. This is a strategy that the FTC and DOJ have used in the past in other areas, in pharmaceuticals, in hospital mergers. They are slowly improving the law. That's why I think Congress really needs to jump in, because we cannot wait for that long process of bringing case after case to show fruit. We need to move now.
Do you think business models will change because of, legislation in the EU when we think of the DMA? Do you think, South Korea is 2021 when they had the first law to require other payment systems within these app stores?
Yes, so I think that's another example where I'm hopeful that some learning will take place, because Apple was able to make some small changes, but still prevent competition from coming in. But yes, I think these companies may sometimes, as they're making changes for one jurisdiction, they may find it more efficient to make that change across the globe, or they may not. So I think it's also on the other jurisdictions' governments and on consumers to notice. This is what I'm hoping American consumers will notice. Wait a minute, EU consumers are getting the benefits of competition. They're getting lower prices, they're getting better products, they're getting easier access, and fight for that for ourselves.
We want to thank you, Public Knowledge Competition Policy Director Charlotte Slayman. Really interesting take on what has been a thick and fast week when it comes to competition. Meanwhile, let's just go out to Germany right now, because Axel Springer is granting ChatGPT maker OpenAI the right to use content from its news outlets to develop artificial intelligence models and respond to queries from users. Now, it's all part of a deal announced today. San Francisco-based OpenAI will pay Axel Springer for articles and other content from the publications that include, like Politico, Business Insider, European properties like Bild and Die Welt, the company said in a joint statement. ByteDance, it's reportedly backing away from plans for its next virtual reality headset from its Pico subsidiary. Now, the information says that Pico will instead focus its efforts on an updated version of the latest headset, the Pico 4. This comes amid some pressure, of course, in terms of competing with Meta in the VR market.
Right, I reported earlier this year that Meta and Tencent are teaming up on a headset in China. It's a good segue into the broader topic of augmented reality. Our next guest founded a company that uses AR to help monetize tasks in the manufacturing industries. Joining us now with more is Devin Bouchon, CEO of Squint, which recently announced a $13 million Series A funding round led by Sequoia Capital. The use case is fascinating, right? Think of an assembly line, training workers, visualizing the industrial workspace. But what is it that's unique about your technology? What is it that you do?
Thanks for having me, Ed. It's great to be here. So Squint is an augmented reality product that lets you create a how-to guide for every machine on the factory floor. So manufacturing today is going through a period of really high turnover, and as a result, they're having to hire more workers than they ever have. Traditionally, the way that they trained these workers was they would actually pair them with an experienced operator, and that person would look over their shoulder and guide them through the process as they worked, and this would take weeks. Now, this doesn't scale as you hire more and more people, so that's where Squint comes in. Squint is that app that lives in that new operator's hands, and it lets them point it at a machine, and it actually recognizes what they're looking at and then guides them through that process as if they were the expert themselves. And now they can do it without any help from that experienced operator.
To be clear, you are not an OEM, you're not a maker of a headset. What you're doing is providing a very specific software platform to make best use of a headset.
Exactly. So Squint actually works on any phone or tablet today, and manufacturers can pull it up instantly and basically go through this process and make any operator an expert.
You have a pretty lean team when it comes to building this sort of software and technology. I'm interested, Devin, in ultimately, therefore, what you do with this capital. Where do you need to be driving now? Because you've already got a lot of well-known customers. I'm thinking Volvo, Siemens, Colgate-Palmolive, for example.
Yeah, we're really excited that we raised this Series A, and really now we're looking to invest in our go-to-market efforts as well as our engineering, product, and design org. And, we're thrilled to basically grow this footprint of impact that we've created with our customers.
How expensive is talent now to get with Squint? Is that one of the top costs right now?
So I think, talent is always a hard thing to procure, especially in the Bay Area. And with Squint, I think the attraction with working on new technology like this is a big help. When we work with our customers, we repeatedly hear that they've cut their training time in half. And that's really attractive to new talent in Silicon Valley.
Devin, Squint's essentially a developer, right? And I wonder how much of a constraint the hardware is. Are you kind of technology agnostic, whether your customers use devices that are iOS or Android? How does it work in practice inside a customer's factory?
Yeah, so we are technology agnostic. This works on an iOS tablet or an Android tablet or phone. The way that it really works is, let's say, I'll give you an example. So a couple of weeks ago, I was at a large food and beverage manufacturer.
Which one?
I can't
keep going.
But they had a robot arm that only one expert knew how to use. And I was only there for a couple hours. So what we did was we actually walked up to this arm and I made a map in Squint. This takes about a minute. It just uses the camera. No additional expertise required. And then I filmed a video of that operator doing their job. And later in the day, we pulled in their HR manager, literally someone who has never used a machine before. And they used Squint, and they were able to perform that procedure at the same quality as the expert in minutes.
Therein lies the selling point for Squint right now. We thank you so much, CEO Devin Bhushan, joining us on the technology in the manufacturing, particularly arena. Meanwhile, look, that does it for this edition of Bloomberg Technology, Ed.
Yeah, it's been a busy, wild week from AI to antitrust. A lot to recap on the podcast. Lots of you listening to the podcast, wherever you get it, Apple, Spotify, iHeart, and every day we're publishing it to the Bloomberg platform. And don't forget, the show is also on YouTube, on the Bloomberg Technology YouTube account. Big week still to come. From San Francisco and New York City, this is Bloomberg Technology.